Hello everyone, this is Drew from Best of Us Investors working with Mark on the Platinum Trading platform. As you may know if you have been a subscriber on the channel for some time now, Mark, who has been successfully investing for over 40 years and warned us to get out of the market in 2021 November when the market was at its peak, is now helping our subscribers on swing trades, analyzing more than 1,000 companies each week based on 10 indicators and sharing the ticker symbols of the stocks that are set up for good uptrends every day, along with weekly Zoom calls for Q&As with the members. So if you might be interested in our service, please make sure you check the link in the description below. So we had another scary week where all the indexes were down significantly and the fear indicator was also reaching the extreme fear level. Now, as I've kept mentioning, when you are looking for individual stocks to trade, it is very important that you first read the indexes like the S&P 500 to get a better idea on how the market is doing in general. Once you could read the charts and flow of the market in general, you will have a much better idea whether this is a week to pull the trigger for a buy and start a swing trade, or just lean back and look for stocks that are setting up for great trades. So for this week, Mark has not only shared his analysis on the S&P 500, but since the S&P 500 is dependent on the top 10 stocks, Mark has also shared his thoughts on the index that equally distributes each stock in the S&P 500 so that you could have a better idea on the general market and see how the majority of stocks are actually doing. So with that, let's take a look at what Mark had to say about the market last week.
This is the S&P index, okay? So we got into this point back in the middle of September where we just rode this channel down and it was bouncing between the channel. And then this week we got into this sideways pattern. But what's in the S&P? Well, the S&P is market weighted, and market weighted means it goes by your market cap. So the top 10 stocks in the 500 or 7, basically the Magnificent 7, are market capped at 25 to 30% of the index. So those 7 to 10 stocks really move the index. So when you look at that, you know, they say the S&P is good, and here's the 200-day, and we haven't crossed into the 200-day yet. In fact, you know, the 200-day is right around the 4,200 level, which is a long-term support and resistance line for the S&P. And you see we're toying back up at the 4,300 level now. And so everyone looks at that and says, well, you know, the market's not doing so bad. But if we go over to an equal weight XPX, where every stock in the S&P 500 is equal weighted, and right. So Microsoft is as equal weighted as Paul's Stamping Company, here's what happens. We've been under the 200-day simple moving average for a couple weeks now, and you can see the trend. And today you can see the market's up, but we're still underneath the 9-day. So those mega cap stocks has made a difference in not only the NASDAQ, but the S&P also. And that's why you're seeing the Dow Jones go down, because those mega caps aren't all in the Dow Jones. So those stocks are trading differently. And every Friday or payday, a certain percent of your check, for most people who have 401ks, 15% or 20 or 5, goes into your 401k, and most of that goes into some type of an index fund. And that money goes into what? You know, you go to an index fund where it says I'm total stock, or I'm a growth index fund, or I'm a growth and value index fund. You look at the top 10 stocks, they're all the same. They're Amazon, they're Google, they're Meta, they're Tesla, or NVIDIA, all of them. So that money goes in and they have to buy into that. And so that just fuels even more of the buying of these mega caps, because no fund at the end of the year or the end of the quarter wants to look bad because, you know, they didn't have the growth stocks in there that everyone's in.
So as Mark just shared, if you look at the S&P 500 that are mostly dependent on the top 7 to 10 stocks, it may seem that the market is still above the 200 SMA and therefore still in an uptrend with just a pullback going on. However, if you distribute every stock in the S&P 500 equally and take a look at the general market, it is definitely below the 200 SMA for sure and is obviously in a downtrend. Now, I'm not saying that the market will crash or go down 20 to 30% right away, but I think Mark's insights gave me a much better idea on the situation where the majority of companies are in the S&P 500. But again, even if the majority of stocks are down, the top tech stocks in the index might be able to keep the market going higher, so never trade on someone else's analysis. Now let's see what Mark has to say about Apple, which is definitely the top stock in almost every index or in many ETFs.
This morning we put Apple on the Horizon list, which is not the watch list, and the reason I didn't is because when I do my analysis, it was before, you know, the jobs report came out. It was early in the morning. And the RSI this morning, as of yesterday, was at 47. So it wasn't up to my trading plan. So you can see what happened today with Apple. So this is where we put it on. This white line represents where we put it on our horizon list. And of course, everything dropped down this morning, and this is the second day in a row. And the reason I put it on is because it had a one candle close above this 9 level. And then we came down, we just barely touched off the 9. And then we came back up to the resistance level. This is the intermediate resistance level that my program puts on. And it's pretty good indicator. You can see over here becomes support or resistance when it starts getting around it. And it topped right off, right at it. And had I traded in this, which I didn't because I don't like to trade on Fridays, this is where I would have set a limit to get out, is right up at this resistance level. Now, it may go past like it did over here. It may go up and hit off the 50, but I'm more of a conservative trader, and I like to take my profits and get out when the lines and the indicators tell me to do that. But when you look at it, we got a nice rising MACD. We got a nice stochastic that's above its percent D line. And we finally got an RSI. It's above 52. So we can get past this resistance, which we haven't yet. We could roll up to the 50 here. I'm looking at a Bollinger Band that's coming down, and you see they're narrowing. And what that means is we're not having as much volatility from highs and lows. We're starting to get into maybe a sideways trading pattern. And that's what worries me, that we're just going to kind of bounce back and forth. So that's why I would have got out of that. But yeah, you can still trade even if the markets are down. But this morning, it would have been pretty scary if you got in there and then it dropped down, and almost hit the 9 or went down below the 9 like it did over here. So here's a year chart of Apple. So here we are right now on Apple. We're right here on the resistance line. So had you got in over here, you've held your stock all the way from June to today, and you've made no money. So this is opportunity cost. So where we've not been trained as our thought process is on buy and hold, and it works over time. If you are dollar cost averaging in your 401k and you do it for 40 years, you're gonna have a pretty good nest egg based on the history. But if you're getting close to retirement, you want to get out here, and this is, let's just say on this one, here's the 9-day, and if you're trading like on my trading plan, you would have gotten out there, you've gotten in here, there, you've gotten in back here and out up here because you're trading against everything. You watch your indicators and your oscillators. But had you just stayed in and you're at this point now, this is October, so we've been 4 months and you're back to even. This maybe go back up, and you may have a lot of time. You may have 40 years. I don't want this here, and I got in here and now I'm below. I don't want this to keep going. If I can get out with a couple percent loss here, miss all this and get back in here, come back up, get out and do the same thing, then I'm making some money. But the whole key is you've got to learn in your swing trading account, and you should have an investment account where you don't screw with it either. I mean, I wouldn't be doing this with my life savings, but in investment accounts, that's what we're going to talk about next, is how to reduce the drawdowns on your investment account so that you don't get pulled down 25%. You need 33 to get back to even, which we've all been in. But on swing trading, we're just doing it. You could be in this trade a day. You could be in this trade several days, a month, or you could be in it, 3 months. Just depends on the trend and what you're using as indicators and oscillators to make your decisions.
So with that, if you are interested in these swing trade updates, daily ticker suggestions, educational content, and live Q&A with Mark on a weekly basis, make sure you join our Platinum member in the description below so that we can make it through this tough market together. So thank you very much for watching, and I'm looking forward to seeing you all on our weekly Zoom calls.